Hey everyone. In today's video, we're exploring the Williams percent R indicator. We'll go through the entire process, from explaining how the strategy works to optimizing it using FreckTrade, an open source trading bot, and finally running backtests to see how it performs. If you're looking for a complete, beginner-friendly FreckTrade tutorial, be sure to check out the link in the description below. Before we dive into the strategy, let's start by breaking down the key indicators we'll be using. 1. Williams percent R. The Williams percent R is a momentum-based oscillator developed by Larry Williams. It tells us whether the market is trading near the top or the bottom of its recent price range. This indicator moves on a scale from 0 to -100, and it's commonly used to identify potential reversal zones. When Williams percent R falls below -80, the market is considered oversold. This suggests that selling pressure may be slowing down, and a potential upside reversal could be forming. When it rises above -20, the market enters the overbought zone. This indicates that buying momentum might be fading, increasing the likelihood of a pullback. 2. RSI. The RSI, or Relative Strength Index, is a popular momentum indicator that measures the speed and magnitude of recent price movements. It helps us gauge whether the market is gaining bullish strength or shifting toward bearish pressure. In this strategy, we're not using RSI as an overbought or oversold signal. Instead, we're using it as a trend confirmation tool. Here's how we apply it. When the RSI crosses above 55, it signals increasing bullish momentum. Buyers are gaining control, and this is where we begin looking for potential long entries. When the RSI crosses below 45, it indicates growing bearish momentum. Sellers are taking over, and this becomes our trigger to look for short positions. 3. Moving average convergence, divergence. The MACD is a powerful momentum indicator used to spot trend shifts and identify potential buying or selling opportunities. It works by comparing short-term and long-term price momentum to reveal changes in market direction. The MACD consists of two key components: MACD line, calculated as the difference between the 12-period EMA and the 26-period EMA. Signal line, a 9-period EMA of the MACD line, which helps smooth out the movement and highlight clearer signals. Here's how we interpret it. When the MACD line crosses above the signal line, it shows rising buying pressure and strengthening bullish momentum. When the MACD line crosses below the signal line, it indicates increasing selling pressure and potential bearish momentum. Now that we understand how each indicator works, let's walk through how we combine them to identify trade setups and generate entry and exit signals. To enter a long trade, we need all of the following conditions to be met. 1. Williams percent R must first drop below -80, entering the oversold zone. Then, it needs to rise back up toward -40, indicating that momentum is shifting from bearish to bullish, and buyers are stepping back in. 2. RSI bullish confirmation. The RSI must cross above 55, confirming that bullish momentum is building and the market is trending upward. 3. The MACD line must cross above the signal line, signaling increasing buying pressure and a potential trend reversal to the upside. Once all three conditions are aligned, we open a long position on the next candle. After entering, we set the stop loss just below the low of the signal candle. To give the trade some breathing room and avoid being stopped out by normal market fluctuations, we subtract 2 times the average true range from the closing price of the signal candle. For our take profit, we use a 1.5 to 1 reward to risk ratio. This means that once the closing price of a candle reaches our target level, we exit the trade and secure the profits. To enter a short trade, we reverse the logic of our long strategy. All the following must be true. 1. Williams percent R rises above -20, overbought, then falls back toward 55, signaling bearish momentum. RSI crosses below 45, confirming downward momentum. 3. MACD line crosses below the signal line, indicating selling pressure. Once these conditions align, we open a short position on the next candle. The stop loss is set just above the high of the signal candle. adjusted by adding 2 times the ATR for volatility. For take profit, we use a 1.5 to 1 reward to risk ratio, aiming to secure profits greater than the risk on each trade. Now that we understand the strategy, let's move on to optimization using FracTrade. The key parameters we'll focus on optimizing include Williams percent R. Threshold defines the level where Williams percent R must pull back to after entering the overbought or oversold zone. Williams percent R rolling window controls how many candles we look back to identify oversold and overbought conditions. RSI threshold determines the exact RSI level that confirms bullish or bearish momentum. RSI and MACD rolling window specifies how long the RSI and MACD signals remain valid. This is important because these indicators don't always cross at the same time. Risk ratio and ATR multiplier define our stop-loss distance and reward to risk ratio, which together shape the overall risk management and trade behavior. We'll use FracTrade's HyperOpti feature to find the best combination of these parameters for maximum strategy performance. All right, let's take a closer look at the back-testing results. We tested the strategy on ARB perpetual futures using a 1-hour time frame over the past year with the optimized settings. Here's what we observed. The strategy achieved a total return of 305%. By comparison, the market itself saw a return of around negative 40% during the same period. The maximum drawdown was 19%, which shows that while the strategy did experience some retracements, it effectively managed risk and maintained overall profitability. Next, we'll review a visual summary of these results. The strategy was optimized with 8 months of in-sample data and then tested on 4 months of out-of-sample data, ensuring it performs reliably on unseen market conditions and isn't just curve-fitted to historical data. If you'd like access to the full strategy file, along with the complete step-by-step FracTrade tutorial, it's available to supporters through the link in the description. There's also a pair-optimized version, which allows you to apply the strategy across multiple trading pairs, each with its own optimized parameters for improved performance. If you found this video useful, remember to subscribe, enable notifications, and share it with others who might benefit from it. Thanks for tuning in. See you in the next video.